VOO and SPYD are both S&P 500 ETFs, but they're not designed to do the same job. One is built to reflect market leadership as it emerges, and the other is built to systematically target higher dividend yield from a screened subset of the market. That single design difference drives how these funds behave across sectors, volatility, drawdowns, and market regimes. VOO is a low-cost, market cap-weighted ETF that tracks the S&P 500 for broad US large-cap exposure. SPYD is a rules-based ETF that selects high-dividend S&P 500 stocks and equal weights them, creating a systematic yield and value tilt. VOO is S&P 500 core exposure. SPYD is a dividend-screened subset with equal weight structure. That one design choice drives differences in sector exposure, volatility, drawdowns, and regime performance. Most investors compare ETFs using dividend yield and past returns. That misses the mechanism that drives outcomes. VOO is market cap weighted. Larger companies get larger weights. Price movements automatically change the weights. Sector exposure follows market leadership, so VOO concentrates into whatever is leading the S&P 500. SPYD is built differently. It screens for high dividend yield inside the S&P 500. It holds a subset of the index, and it equal weights its holdings. Equal weighting changes two things. First, it reduces mega-cap concentration. Second, it increases exposure to smaller large-cap constituents within the S&P 500. VOO gives you market leadership exposure by design. SPYD gives you high yield exposure, evenly weighted by design. Dividend yield is not a separate source of return. It's one component of total return. Long-run equity ETF returns come from four drivers: earnings growth, valuation change, dividends paid, and share count effects, buybacks, or dilution. Dividends matter, but they don't override the other drivers. A high dividend yield usually signals slower expected growth, more mature business models, and higher sensitivity to rates and credit conditions. That's not inherently good or bad. It's a different exposure profile. So if you pick an ETF based on yield alone, you're not picking income, you're picking a factor exposure. SPYD versus VOO is mostly a factor and sector decision. VOO is market cap weighted, so it holds more of the largest growth companies during growth-led cycles, and it concentrates in sectors like technology when those stocks dominate index weight. SPYD tilts differently. It tilts towards value, high dividend yield, equal weight characteristics, and lower exposure to mega-cap growth leadership. It also concentrates in sectors where high yields are common, like financials, utilities, and real estate. Sector weights move over time, but the directional bias is consistent. And sectors behave differently across regimes. Rate sensitivity, commodity sensitivity, credit sensitivity, and defensive versus cyclical earnings. So when you buy SPYD, you're not just buying dividends. You're buying a systematic set of sector and factor exposures. To make this decision correctly, ignore last year's performance. What matters is which regime is driving returns. Regime 1, growth-led markets, when a small group of mega-cap winners drives the index. VOO tends to lead, because market cap weighting concentrates into the winners automatically. SPYD tends to lag, because it underweights those leaders by design. Regime 2, value-led or broadening markets, when returns spread across more stocks and leadership rotates. SPYD can outperform, because value, yield, and equal weight exposure start contributing more. VOO can still perform well, but it becomes less dominant when leadership is less concentrated. Regime 3, stress and repricing environments. When rates, credit, or earnings expectations reset, high-yield portfolios can look defensive, but they're not automatically safer. SPYD's outcome depends on whether its sectors are acting defensive or cyclical in that specific shock. In those periods, the key risk is dividend sustainability, not just dividend yield. VOO wins when leadership is narrow and persistent. SPYD wins when leadership broadens and rotates. That's the structural trade. The biggest hidden risk in high dividend strategies is dividend cuts. Dividend cuts usually happen when cash flows weaken, leverage becomes restrictive, or sector profitability resets. And when a dividend is cut, the stock price often falls too. Yield-focused buyers exit, confidence drops, and the market reprices forward cash flows. A high dividend yield screen can also select the wrong things. Temporarily high yields because price already fell, unsustainable payout ratios, and sectors where dividends are cyclical. This is not unique to SPYD. It's a known behavior of yield screens. So if you choose SPYD, you're accepting more dividend policy risk, more sector concentration, and drawdown risk tied to dividend cuts and cyclical profitability. Many investors think SPYD is mainly about yield. Equal weighting is just as important. Equal weighting does three things. It reduces mega-cap concentration, it increases exposure to smaller names in the eligible set, and it forces rebalancing away from winners and into laggards. That can create a rebalance premium in some environments, but it also increases turnover, and it can increase volatility versus market cap weighting. If you want the market's momentum towards winners, VOO aligns with that. If you want more balanced weights across holdings, SPYD aligns with that. If your primary goal is cash distributions, SPYD targets a higher dividend yield than a standard S&P 500 ETF. But evaluate income correctly. First, cash yield versus total return. Higher distributions don't guarantee higher long-run wealth. Total return is what compounds. Second, taxes in a taxable account. Dividend-heavy ETFs can create higher current tax drag, less control over timing, and less flexibility than selling shares strategically. VOO's lower distributions can become more tax efficient for long-term holders. Third, sequence risk in retirement. Dividends can reduce forced selling during drawdowns, but dividends can be cut, and dividend strategies can still have large price drawdowns. Dividends help with cash flow, they're not a contract. Here's a direct framework that you can apply. Choose VOO if you want broad US large cap exposure, maximum participation in market cap leadership, lower complexity and fewer structural bets, and generally stronger tax efficiency in taxable accounts. Avoid if you specifically want higher distributions, if you want to reduce mega cap concentration, or if you want a deliberate value and yield tilt. Choose SPYD if you want higher current income from equities, a systematic value and yield tilt, less mega cap concentration, more exposure to dividend paying sectors, and potential outperformance when value and dividend factors lead. SPYD is not a market replacement, it's a targeted tilt. Avoid SPYD if you expect persistent mega-cap growth leadership, if you want minimal sector bias, or if you're not comfortable with dividend cut risk. Here are the common mistakes to avoid. Mistake 1. SPYD is safer because it pays dividends. Dividends don't remove equity drawdowns. They change the source of return and the risk exposure. Mistake 2. Chasing the highest yield. High yield can reflect higher payout risk, lower growth, sector stress, or elevated leverage. Mistake 3. Comparing only the last 1 to 3 years. SPYD versus VOO rotates by regime. Short windows often capture only one regime. If you want a simple structure without over-optimizing, here are some options. Option 1. Single fund approach. 100% VOO for US equity exposure. This is the simplest default. Option 2. Core plus tilt. The core, VOO. The tilt, SPYD. Keep VOO as the majority. Use SPYD as a smaller allocation and rebalance periodically. Measure it against the objective, income, concentration control, or factor diversification. Option 3. Income sleeve. VOO is the equity core. SPYD is an income-focused equity sleeve. And add bonds or cash for stability and spending needs. This is closer to how multi-asset portfolios manage cash flow. Here's the entire decision in 5 lines. VOO is broad US large cap S&P 500 exposure. SPYD is a high dividend, equal weight tilt with sector and value exposure. VOO tends to lead when mega cap growth leadership dominates. SPYD tends to lead when value and dividend factors are rewarded. Choose based on objective, market simplicity with VOO, or income and factor tilt with SPYD.